Good morning, ladies and gentlemen, and welcome to this broadcast of the GRC International Group PLC results for the financial year ending March 23. In the course of this session, we're going to give you a brief summary of FY23, a bit of the context to those results. Chris Hartshorn, our Finance Director, will give you a walk through the financial update. We'll then take a look at the forward plans and give you a trading update, cover off the investment case. We're not going to talk through the various appendices. Those will be available to you to have a look at separately, but there's quite a lot of useful information about the company and the detailed financials in those appendices. I'm Alan Calder. I'm the Chief Executive of the group, the original founder of IT Governance, the business, which is the biggest brand inside the group. In the period immediately following what we call the GDPR salmon run, so post-May 2018, when GDPR came into force, GDPR services went into reverse. We set ourselves 4 significant objectives. The first was to rebuild revenue growth in the group around a combination of cybersecurity and privacy, to recover gross margins to in excess of 60%, to build contracted and recurring revenue to in excess of 70% of total revenue, and to consistently generate positive EBITDA. We've now achieved all 4 of those objectives, but I want to give you a bit of context to why those objectives were significant and what we've achieved over the course of the last 4 or 5 years. In the period leading up to our IPO, which was in February 2018, IT Governance was the single brand in what is now the GRC group. It was a very strong brand. It was primarily a cybersecurity brand, and it was a one-stop shop supplier of products and services. And we saw in the GDPR legislation, which was due to come into force in May 2018, the opportunity to make a significant change to the structure of the group by building a lot of services around what would be a compliance-driven set of requirements around data protection compliance. We therefore had a very wide-scale GDPR focus, and we had rapid revenue growth on the back of that focus. So revenue scaled up from 4.8 million in FY16 to 15.7 million in FY18. As you can imagine, there were significant immaturities in services and systems as we grew as fast as we could from very little to somewhat larger. Data protection went from about 4% of our revenue in FY16 to 57% of our revenue in FY18. Back in FY16, recurring revenue was only 2.5% of total revenues, and we came to market in February 2018 and then acquired DQM shortly afterwards, which kind of led to the growth of the post-IPO strategy. Post-IPO, what we'd expected to happen was that demand for GDPR might have gone into a bit of a slowdown over summer, but then continue rising. It actually went into reverse. So the GDPR salmon run ceased, and we then had a series of market shocks and issues to deal with, from the turmoil over Brexit and how to execute Brexit and the government issues and uncertainties around that, COVID-19, the Russian invasion of Ukraine, the global monetary tightening and global economic headwinds of now. All of those, one way or another, create challenges for most organizations. Data protection revenue went from the high of 57% down to 31% of revenue in FY20 and is now back up to 37% of revenue as we've grown cybersecurity and privacy revenue in tandem as we've got the business on an upward trajectory. We obviously right-sized the cost base. We took staff down from a peak of about 270 to about 170 odd at the end of the last financial year, much lower even earlier. Restructured the business into 3 revenue divisions, so professional services, e-commerce, and software as a service, as we can focus on where we wanted to grow our activity. And we built out additional specialist brands. ITGP already existed. We spun it out into a business. Vigilance Software, GRC e-learning, DQM we acquired, and GRCI Law are all businesses which exist only to develop really good services in their own right, which they sell through the main IT governance brands in the UK, the EU, and the US, but they're also able to sell directly to clients who are interested in their particular expertise and product, and of course, potentially to competitors of IT governance as well. When you look at the story of those years in figures, there are a number of figures which kind of leap off the slide at you. You can see our revenue in the top line going from 6.8 million in FY17 to nearly 3 times that in FY18, and then coming down. It was boosted by the DQM acquisition in FY19, really came down in the pandemic of FY21, and we've built it back up now, so it's running just a little bit behind where it was at the peak of the GDPR salmon run. Gross margins declined. We've rebuilt them to 61%, which is where we think we need to be. They declined to the worst number at 52% post GDPR salmon run. We've achieved 2 years of positive EBIT in 22 and 23 in spite of investment in quality improvements through FY23. Cash, we've always been tight on cash. A couple of years where we raised cash. You can see big cash balances, but those had very specific objectives rather than to support general funding. We've always been able to fund our ongoing activity out of our self-generated cash. Average full-time equivalent employees went up very dramatically, rolled over into FY19, and then has come down and stayed relatively low, so that the revenue, the productivity measure, if you like, of revenue per full-time equivalent employee is in FY22 and 23 almost back up at the level that we were in FY18, and we're aiming to improve that in this coming year and the year ahead. Privacy and cybersecurity, you can see how the balance changed. FY17 from 29% privacy and 71% cybersecurity to 37% privacy and 63% cybersecurity in the most recent year on the far right. And our recurring and revenue has gone up from 5%, 2.5% before that, 5% in FY17 to 73% in the most recent year. That's why I say the objectives we achieved in the recent financial year are significant marks of progress in the turnaround of GRCI following the GDPR salmon run. The other thing the slide demonstrates is the extent to which boards don't understand their GRC obligations and the way in which finance directors tend to defer security expenditure in response to external shocks or whenever the economic horizon gets cloudy. So Brexit turmoil, turnover is affected, COVID-19 pandemic, turnover is affected, the Liz Truss, Boris Johnson chaos in the British government, Q3 revenue last year affected, Ukraine invasion, fuel prices go up, finance directors say let's defer expenditure. It's always been a challenge for an organization like us, and that is why the things that are happening in the market today are so important and significant. I'm going to talk about those shortly when we get to look at the forward plan. In terms of operational highlights, ARR, annualized recurring revenue, up 31% to 10.9 million from 8.3 million in the prior year. 3,000 software as a service customers. We've managed to drive up the average value by about 5%. We've increased the number of public course training delegates over the year, and in particular in Q4, a 17% increase on the prior year, partly by expanding the training course portfolio, partly by introducing a digital badge so that people, when they get a certification, have got a badge they can boast about on social media, which we can take away if we need to, but which enables them to continue doing our courses in an approved fashion. We completely revamped our ISO 27001 product portfolio, the 2022 version of ISO 27001. There are 60,000 companies worldwide who have to upgrade their existing 27001 management system to the new standard by the end of October 2025. So we've completely revamped our product portfolio to support that. Through this last year, we've invested particularly in quality of services, in quality and efficiency of delivery. Our NPS, Net Promoter Score, is now up to 48, just tad short of the excellent marking of 50, and our Trustpilot average, which is much more focused on our e-commerce business, runs at about 4.5 out of 5, which is officially excellent. Most importantly, we've combined what were a number of independent cyber comply modules into a single platform, added incident response management functionality, and enabling us to sell cyber comply as a single solution to the challenge of how to comply with the emerging range of cyber regulation. When you look at the operational highlights across the 3 divisions, I'm not going to spend a lot of time on them. You can explore that at your leisure when you download the slide pack. But in particular, our software as a service division, revenue up about 11% year on year. Our services division, and when we came to market, we were primarily a professional services business. The overall growth of the business focused other than on professional services, still sees professional services growing, so it's just under half of our revenue, still a 6% year-on-year increase. And because of that set of deferrals and finance directors say no challenges in Q3 last year, our e-commerce revenue flat at 3.6 million. But as you can see, services now less than half of our total revenue, and the e-commerce software as a service, where we have higher margins, are the bigger part of the business. That seems like a good point for me to hand you over to Finance Director Chris Hartshorn to talk you through the financial results. Chris.
Thank you very much, Adam. So the slide on screen at the moment simply sets out the financial highlights for FY23, taken directly from the RNS statement that we released to the stock exchange a short while ago. So revenue up 6% for the year to 14.7 million, up from 13.9 million in FY22. Within there, our international revenue, and that's predominantly our IT Governance USA and IT Governance Europe businesses, that revenue up 3% to 3.1 million. Our SaaS division revenue up 11%, as Alan's just mentioned. Pleasing to see the group's highest gross margin division delivering the highest level of growth in the year. Our recurring and contracted revenue was up 30% to 10.7 million, up from 8.2 million in the prior year. And Alan's mentioned the importance already of improving our overall recurring revenue figures, improving the overall visibility of our future performance. We're now in a position where 73% of our revenue comes from recurring revenue type contracts. That's up from 59% in the prior year. Our overall gross margin for the period was up 2 percentage points from 59% in the previous year to 61% this year. That overall shift is driven by 2 things. Firstly, it's the shift and continued movement towards SaaS products and software products within the group. And it's also a reflection of the investment that we've made into automation in our e-commerce division, and it's the result of a number of operational efficiencies that we've seen as a result of specific projects in the services division. Adjusted EBITDA for the year of 0.3 million, 1 million in the prior year. There's a slide next that will talk about EBITDA in a little bit more detail. And we finished the year with a positive cash balance on the balance sheet of 0.1 million. On the next slide, we look at EBITDA in a little bit more detail. EBITDA of 0.3 million, down from 1 million in the prior year. And the story of EBITDA for the year, in truth, the story of revenue as a whole for the year was really as follows. H1, good revenue performance, solid EBITDA performance, up on the prior year for both those metrics, and really finishing H1 exactly where we wanted and expected to be. As we entered Q3, we invested in line with our plans into specific lead generation and marketing campaigns. We also invested into some additional headcount that we expected to fuel a higher level of growth into H2. And H2 is traditionally our stronger financial performance period. Right around that exact same time, we saw economic turmoil in the wider market. We saw the impact of the death of the Queen. We saw additional bank holidays have an impact on people's working days. We saw the Liz Truss government and the upheaval of the mini budget. As a result of that, as Alan's mentioned, we saw an impact on 2 of our divisions in particular, the e-commerce division and the services division. we saw an awful lot of finance directors up and down the country in our e-commerce division simply saying they were going to hold back on expenditure, cut back on budgets for things like training courses, distance learning products, and those kinds of products that sit in our e-commerce division. In our services division, we saw a similar issue, not so much a lack of people wanting to get on with signing significant consultancy projects, but more a case of the sales cycle extending. So traditionally, we've seen salespeople sign contracts maybe 3 or 4 weeks after they first started talking to people and scoping a project. What we were seeing during Q3 was it taking sometimes 11 or 12 weeks for customers to get all of the levels of authorization they need and the final sign-offs they needed from their finance teams in order to get on with signing contracts. And that resulted in a big backlog of sales opportunities through Q3 that we were then unable to convert until Q4. In Q4, the performance came back with a much stronger level of momentum. We start to see return on the investment that we've made into marketing campaigns and lead generation campaigns. And that momentum then continued in Q3 into Q4 and continued through into the first quarter of this year. And both Q4 of last year being EBITDA positive and Q1 of this year also being EBITDA positive. The slide on screen at the moment sets out some of the divisional performance for revenue and gross margin. I won't go through all of the details on the screen. You can do that at your own leisure when you have a look at the slide pack. But 2 points worth pulling out in particular are the point around the gross margin improvement, where not only did we see an overall improvement across the year, we also saw steady improvements through the year. So through H1, we were seeing steady month-on-month gross margin improvement, an obvious dip in gross margin through Q3 because of the reasons that we've just talked about, but then a really strong gross margin performance again through Q4. And through Q4, we were regularly seeing gross margin up around 64–65%. The other point just worth highlighting is the international revenue. Again, as we've talked about, up 3%. We service most of our IT governance USA clients and most of our IT governance EU clients through entities set up in those geographic regions. And as those markets become a bigger part of our business, we expect for that to provide a partial hedge against any natural FX risk that the group incurs. The final slide in the finance section, just before I hand you back to Alan, just sets out the cash flow movement for the year. And although there's a significant cash outflow of £2 million during the year, it's very important to recognise that's a very different thing to cash burn. So in January 2022, we raised £3 million on the stock exchange, and we raised that for 2 very specific purposes. One of those was to invest into software development and into product development. And the second of those was to clear some HMRC debt that we'd built up through the COVID pandemic period. The total value of capital expenditure during the year is just short of 1.6 million, and in excess of £1 million was paid out clearing that HMRC debt. So those 2 things together, you can see add up to more than the total value of the cash outflow during the period. So the underlying working capital movement, excluding those 2 specific items, is cash positive. We ended the year, as we've said, with a positive cash balance and significant levels of headroom on our facilities that are available for us to be able to deal with unforeseen circumstances going forwards. There is a full balance sheet in the appendices to this pack. I won't propose to go through it now. Once you've understood the cash flow movement and the investment in CapEx during the year, you've really understood the 2 key points around our balance sheet for the period. But the detail is there for people to review at their own leisure. And I'll hand you back now to Alan to talk about the forward strategy.
Thank you, Chris. So turning to the future, looking at what's going on in the world as we deal with today, I've picked a couple of headlines, 4 headlines of recent cyber breaches. They signify, of course, is the fact that cyber breaches are not going away. They are increasing in scale, in volume, in impact. The number of data records, the cost of exposure, all of those elements of cyber breaches are continuing to grow. And the only logical conclusion you can draw from this continued increase in cyber breaches, the traditional ways of dealing with cybersecurity, which is to deploy technology, simply isn't working. If it was working, we wouldn't be seeing continued levels of cyber breach. So when you look at the cyber environment, what you see is that the attack surface is of remote or hybrid working, of people working from multiple places all over the world, means more and more ways in which organizational boundaries are stretched. The migration to cloud to deliver the resilience and efficiencies and support that comes with cloud services, combined with organizational digitization. We're only in the early stages still of that as a strategy. The Internet of Things means that there are more and more ways in which vulnerabilities expose personal, corporate, and other information. And that means that the threat horizon is getting more and more crowded as more and more criminals and others identify the opportunities that the expanding attack surface brings for them. So serious organized crime has a well-established capability around cybercrime, as do nation states. There are some nation states like North Korea, Iran, Russia, who cut out of the international markets, need to raise hard currency, and they do that through cybercrime in the billions, not in small amounts. But they also, of course, wage cyber war. Competitors resort to cyber competition, and a major area of cybercrime like ransomware as a service has become highly structured and organized, very efficient, very cost effective to deploy using multiple specialists all the way through a ransomware kill chain. So the threat horizon has become very crowded and will get more and more crowded as the attack surface continues expanding. And that's very costly. A Reuters survey published a couple of weeks ago says that cybercrime will cost Germany 206 billion euros in 2023. 52% of German companies think that cyber attacks will threaten their existence, not just cost them a lot of money, but threaten their actual existence. And you multiply that by 100 to 150 economies around the world, it gives you a size of the scale of the opportunities there are for those operating in that environment, and the size of the challenge for organizations trying to pursue their legitimate businesses in that environment. And of course, cybersecurity companies are selling technology solutions to tech teams, but that's the wrong answer, and it's the wrong problem. Try to solve a technology problem when the real problem is human beings. Human beings access technology. Human beings are susceptible to social engineering attacks. They are prone to being interested by a new purchase order that turns up without checking that it's a social engineering attack. They make mistakes. Humans make mistakes, and cybersecurity attackers therefore take advantage of human beings. The ICO has just published a survey saying that one of the most common breaches in the 5 years since GDPR came into force is the misuse of the carbon copy field in an email. Failure to use that field is one of the top 10 breaches reported every single year. Puts into the carbon copy email addresses of people who should be in the blind carbon copy, thereby misusing personal data and causing trouble and causing regulatory challenges. The ICO is taking the view increasingly, apparently it's such an obvious thing that management should have got to grips with, that they're simply going to start fining organizations who report those kinds of breaches. And it is, in other words, about management. Cybersecurity, the right solution to cybersecurity breaches is about what board and management does. Risk management and compliance, and building a GRC-driven cyber defense in-depth framework for an organization that enables it to have resilience, because it has dealt with the different ways in which different attacks take advantage of human weaknesses. It's built out its policies, its procedures, its competences, its capabilities in a way that enables it to stop a number of attacks, to capture a number as they evolve, and to respond to those which are successful. So that includes thinking about supply chain management, business continuity management. It includes, going further outward, cyber essential certification, ISO 27001 certification, all of them GRC-based frameworks. And remembering that cybersecurity and privacy risk are different sides of exactly the same coin. If you have a cyber breach, it almost certainly involves the theft of personal data. If you have a data breach that has to be reported to the ICO, or to some other regulator, it almost certainly involves a cyber breach. So you can't offer services that deal only with privacy risk or cyber risk and help your clients deal with the challenge, because they come together. So cyber resilience, driven by the board, managed by senior management, effective across the organization, is what enables an organization to build genuine cyber resilience. Governments and regulators agree with us. A board-led GRC strategy is becoming mandatory. This all started with UK GDPR, which said that boards are accountable for compliance with GDPR. It said that boards are accountable for deploying state-of-the-art cybersecurity controls to protect personal data, and kind of said, we recognize you won't, so the fines could be up to 4% of global turnover if you don't do it. So that level of compulsion drove a huge shift in terms of compliance. How do you demonstrate that you're GDPR compliant? Up till now, you couldn't, but the Euro Privacy Seal launched this year. We are a global consultancy partner, enables you to demonstrate through an external audit that you are genuinely GDPR compliant, taking a lot of cost out of your supply chain activity, giving assurance to management, giving assurance to regulators, and that encompasses ISO 27001, in which we are a leading global expert, subject matter expert. SWIFT, there are 11,000 organizations who move money. SWIFT system, it's the standard method of moving money. You to demonstrate through a set of GRC controls, risk management, the audit, and so on, that you have a proper set of security controls in place. You can self-certify your compliance on an annual basis in order to continue operating in that environment. The European Union has just put into law the Digital Operational Resilience Act, which requires some 28,000 financial service organizations to become compliant by January 2025. That's obviously EU organizations, but also finance organizations outside the EU providing services into it. There are penalties for failure, but the requirements cover risk management, governance, supply chain security, staff awareness, competence, and so on. It's a GRC set of requirements. And where GDPR led, the rest of the world has followed in terms of privacy regulation. When EU leads with DORA, we expect to see the rest of the world following in terms of financial. Most importantly, perhaps, the Security and Exchange Commission voted 4 or 5 weeks ago to bring in a set of regulations requiring all listed companies in the US to report cyber breaches to the SEC when they happen, and also to certify on an annual basis that both the board and the management have in place appropriate processes to manage cybersecurity. In other words, board and management can no longer go, this is not something that we have to worry about. In the UK, the UK government is planning to launch in next year a cyber governance code of practice, which will require organizations to put in place a governance code of practice, risk management, board involvement, management involvement, proper monitoring, audit, all of the components of a GRC framework around cybersecurity. And that'll become, we expect, a requirement of frontline contractors to the government, of local authorities, and right the way through the supply chain, in much the same way that Cyber Essentials has over the last 6 or 7 years. And of course, all of these changes are reflected in cyber insurance. It's almost impossible now to get cyber insurance as a company unless you can demonstrate that you have in place genuine cybersecurity controls and mitigations for all of the obvious risks, unless you can demonstrate that you're GDPR compliant, PCI compliant, and so on. In other words, GRC-driven cybersecurity is becoming, or has become, a matter of compliance, not choice. Clear penalties for negligence, not actually shareholders might be upset with you, you might lose share price value if you have a breach. Now you have penalties for negligence, and there is even the emerging likelihood of personal liability for directors, particularly in the US. This is a significant inflection point in the market as we shift from this environment of its matter of choice. We should be doing it, but we're not. You've got to be doing it because it's a regulatory requirement. And the market is huge. The addressable market is probably 10 times the current vended market, according to a recent survey by McKinsey. And in this market in particular, GRC focuses on data protection, GRC and security consulting, but we also deal across all the other segments. We provide policy, we provide procedures, we provide competence training. So we are significantly part of every aspect of a market which is 10 times bigger in potential than it currently is. So there's a huge market opportunity for a business like GRC. And that market opportunity comes, that addressable market exists at exactly the point where there's not enough expertise available for those people caught by the compliance requirements to be able to address it. There's a global shortage of cybersecurity subject matter experts, a workforce gap of about 2.7 million people. They just don't exist. They're not trained, they're not coming through universities fast enough to deal with the huge challenge which organizations have to focus on. This is exacerbated by a proliferation of laws, regulations, standards, frameworks, supply chain requirements. 70% of organizations identify a need to demonstrate compliance to at least 6 different information security or data privacy frameworks, which might be sectoral or geographic. But that's 6, which is very difficult for a typical compliance team of 1 or 2 people, a security team, to pull together, but particularly as they tend to overlap. And so tackling them on their own will simply create complexities and super vulnerabilities that you don't get if you are able to integrate the way you deal with them. And to integrate, you need to be able to deal with a supplier who offers integrated services. Once you've complied, of course, 77% of organizations recognize that they will have to update their frameworks. Standards are updated, they're brought up to date with changes in regulation, changes in threat. You have an ongoing, never-ending set of requirements around updating them. So these create a market for vendors that combine a wide portfolio of integrated GRC services with genuine deep subject matter expertise, who can talk to how you implement a particular framework, how you integrate several different frameworks in a way that delivers practical value to clients, peace of mind to clients. All of that supported by a best practice GRC management and compliance platform, which automates and integrates and creates in a robust and systematic way all of the processes that management needs to be able to rely on to operate in an efficient manner to deliver over an extended period of time the level of security that you regulatory have to deliver. And of course, a platform like that needs to be updated on a continual basis so that as laws change, needs to have access to all of the things that you might need to comply with. So that's a real exciting market for a vendor exactly like GRC. And we think of this as a cyber reg tech market. It's a market which is going to become one about technology which enables you to comply with regulation, and particularly regulations which look at cyber and privacy security. So cyber reg tech is what we think of this emerging market as being. And GRC already has the widest, most comprehensive set of GRC related services for cyber and privacy. They're integrated, they are built around governance, risk management, and compliance. And we have a cyber comply platform, which originally we developed to support implementation, but in our future plan, the starting point of conversations with clients, so that we won't talk primarily about how do you implement ISO 27001 using consultants and other tools, but we'll talk about how you implement cyber comply, and through cyber comply, how we then help you with all of the aspects of your implementation and achievement and maintenance of compliance to that standard. We think of the cyber reg tech market, if you think of the cyber tech market, the firewalls, anti-malware software, and so on, as being at around about the middle of the early majority phase. Not everybody has got all of the technology they could have. We've got new technologies coming out the whole time. GRC cyber reg tech is really just at the beginning of the early adopter phase. It's over the chasm. There are enough companies who've identified this as a significant market. We're not the first. There are others who understand the opportunity here. And there are enough companies buying platforms for us to be clear that this is no longer an innovator market. This is an early adopter market. There's huge growth, as I said, when you look particularly at the addressable market for the cyber reg tech market. So in that context, the objectives for GRC as a group, the short-term objectives for GRC as a group, is to continue focused investment in the roadmap for our cyber comply platform. We have about a 5-year development roadmap that builds out use cases and functionality around cyber comply, all of the related SaaS services and e-commerce functionality and growth that enables us to build a significant position in this market. We'll continue developing and launching products that fit across our portfolio, particularly in areas like DORA, Europrivacy, SEC, and so on. And that means documentation. Documentation is now going into our cyber comply platform. It means training courses, it means staff awareness training, it means consultancy services, so that we can deliver the complete package in each of these use areas for our clients as they need to address them. They don't just buy a platform and then go, what do I do? They buy a platform and then go, I need someone to hold my hand. And we have genuine subject matter experts in all of those areas who do exactly that. We're focused, of course, on improving client acquisition, average customer value, customer lifetime value. Improving productivity, as I said at the beginning, is another continued ours. And this should be the year in which, with regulations like SEC and Europrivacy, we begin to see much faster growth in the EU and the US. Of course, that growth will really show through in future years, but we should begin to see it this year. In current trading terms, Q1 of this financial year was EBITDA positive against negative in the prior year. Cumulative billings to August are ahead of the prior year. So we're trading in line with market expectations after 5 months of this financial year. Our busiest and biggest period is the second half. So 5 months in, we're trading in line with expectations. So that kind of then leads me to the investment case for GRC. This is a digitally transformed, cloud-based, increasingly vulnerable hybrid working environment, which is growing at an enormous rate. And that brings lots and lots of opportunities for vendors with our particular mix of products and services, expertise, and platform to help organizations navigate the global shortage of subject matter expertise in complying with the proliferation in regulations and frameworks. The market is fragmented, which means there are significant consolidation opportunities in the longer term. And we are operating this market with a well-established, dominant, SEO-dominant brand, which has been at it for 20 years. We're a EBITDA positive business. We've got an established, resilient ability to cope with what goes on in the market. We've got the capability to grow. Our management team is experienced. We've got a very broad customer base operating across multiple segments, organizations and regions with substantial, as I said, SEO dominance and good PR. All of that translates into a customer acquisition cost of about £420, which is about in line with a professional services business, but unusually a customer lifetime value, in revenue terms, 22 times that. So our customer lifetime value is 22 times the cost of acquisition, and typically the kind of average organizations look for is maybe 3-5 times. With our profit margins, our gross margins, you can easily work out that our customer lifetime value at gross margin point is about 12 or 13 to 1. We've got a unique cyber resilience offering, very wide and deep range of products and services, lots of cross-sell, upsell opportunity, which means that our cyber comply product enables organizations to buy more and more and more from us because cyber comply is embedded in the organization on a 3-year contract basis. All of that supported by unique, valuable intellectual capital, software, content, brands, know-how, supported by multiple national and international accreditations, customer endorsements, high net promoter and Trustpilot scores. All of that says to clients, we know what we're doing. You can trust us. We've been at this a long time. And of course, we also have to recruit staff, but we've got a well-established remote work world and integrate them into our global operation very efficiently and effectively. Cyber comply, or GRC as a business, is more and more a non-cyclical business. We're not a cyclical business in the same way as white goods or consumer durables might be. We are increasingly a business where sales are going to be driven by compliance and regulatory requirements, by the threat of going out of business. We have significant revenue growth, more growth ahead of us. Already 73% of total revenue in recurring and contracted gross margins, already over 60%. And our SaaS and e-commerce businesses are highly scalable. There's inherent operational gearing built into what we do. So we don't need to take on a lot of people in order to scale our revenue up very significantly. And that means that we can drive customer retention, we can improve revenue visibility. Every year we get a better picture of what revenue looks like as we go forward. We're a bit defensive, and before investment in our ongoing platforms, remember we invest in our development in cash flows, we are pre-invest generative. So that's the investment case for us as a business, ladies and gentlemen, and that brings me and Chris and I to the end of our presentation. If you find that you have questions, please do contact us. Our contact details are on the GRC website. And if you have specific questions, we will come back to you. Obviously, there will be questions which we can only answer where the information is in the public domain, but we'll make sure that, that we do that. So thank you all for paying attention to this. I hope the information has been useful, and I hope that you find the additional information in the appendices to the slide pack also helpful in terms of helping you build out your understanding of who we are as a business, what we're doing, and where we're going.